Okay, so very good morning. Welcome to the briefing then for Tuesday, the 25th of October. A quick recap of just where some of the charts lay at the moment, and then we'll get a closer look in towards some of the news flow from overnight. Quite a few things I want to discuss today because I know we had a few issues with the system yesterday. So looking at the DAX at the moment, we're already up again positive, taking a bit of an extended move to the upside through the cash open. So just watching upside, you've got that R1 sitting at pretty much bang on the high print that we're seeing yesterday. Obviously the big catalyst was that data, predominantly led by Germany with the PMI numbers. That caused the bulk of the main market activity for European assets, and so just keeping on that 10,818 level from yesterday. Obviously the R1 sitting at 19 just above. Likewise, in the US, we had a positive close across the board yesterday. We've had a fairly positive tone overnight in Asia, following on taking that lead. But the Nasdaq, in particular, saw some outperformance yesterday. Obviously, one of the key catalysts has been what they're deeming as Merger Monday, following AT&T, Time Warner, and BAT and Reynolds American, which combined, I think the approximate value of that M&A deal or transactions is about $135 billion. You've also had Chinese conglomerate HNA Group agree a deal to acquire a stake in Hilton for $6.5 billion. Aircraft component maker Rockwell Collins announcing a purchase of BE Aerospace for $6.4 billion. And in the financial sector, TD Ameritrade looking to buy Scottrade Financial Services for $4 billion. A phenomenal amount of M&A activity on one single day. And as I was saying yesterday, when that tends to occur, it acts as a positive kind of sentiment or supportive factor for market sentiment. The fact that these companies are willing to outlay large amount of cash. They would only really do that if they were confident of their long-term outlook. Obviously, in times of strife, you tend to hoard cash on the balance sheet to safeguard against potential shocks, this being the opposite. They're kind of putting their cash to work. Now, obviously, timing is key. If you think about it, there's a lot of things coming up towards year end. You've got the US election, Italian referendum, the Fed, ECB, Bank of Japan, or the central banks, and kind of what are they going to do next. You've got the Brexit High Court ruling, you've got the OPEC saga, so certainly it's not massively surprising on the timing. They're looking to get these done before a lot of these other events start coming up. Looking at the Nasdaq though, we breached a fairly significant level last night. Just before the close, you can see it acted as a bit of resistance initially through the late hours of Wall Street trade, and then we actually saw a break just into that final half an hour on the street, and you've got a bit more of a stronger candle on the upside, and then we've trended higher overnight. Now if I put this on a daily, it makes a bit more sense. This is pretty much year-to-date chart that I'm sharing with you at the moment, and you can see that 49.0150 was kind of the upside resistance that had held through much of September, October. So it puts us at the best levels we've been. Well, looking on the monthly chart, I mean, this is a pretty shocking chart when you think about the economic conditions of late, and certainly, any fear over the elections to come in the US. I mean, since the financial crisis, 2009. Through the various intervention measures from central banks, not just in the US but globally, whether QE, negative rates and other non-standard measures, that's a pretty impressive move to the upside. I mean, you're talking about an index that's gone from the financial crisis low, which was 1,000, to now nearly 5,000. That is a monster move we've had over that time period. You're looking at 370% gain in the Nasdaq 100 since the financial crisis. And if I just stretch the chart out a little bit, look where we are now and look at the dot-com bubble. I don't want to scare too many of you. I don't want to be like the doomsday bearer first thing on a Tuesday morning. But, well, I think the chart speaks for itself. We're at levels now which, if we were to look at history, things tend to get a little bit spicy around these levels. So, certainly something to be mindful of, but I guess the difference is, and I'd say the reason why history might not repeat itself is because now we're in a new realm of monetary policy. It's to a point of such stimulus that, as you've seen from the likes of when the Bloomberg ECB source story came about, and you mentioned the word taper, quite literally like it did a few years ago in the US, you have a taper tantrum. It's because the market is so used to being propped up to such a strong degree. And at this point, can they effectively remove those policies? And if anything, we're at the point of adding to that. Certainly outside of the realms of the Fed, other central banks are still very much underway with their various programs. So that takes us to the Fed then. Let's have a quick look. And I saw an interesting article in regards to Bloomberg this morning. They were talking about the Fed, and they were looking at the Federal Reserve is inclined to raise interest rates higher than otherwise if the next president pursues a more stimulative fiscal policy. Now, this is quite interesting because if you're to look at both Hillary Clinton and Donald Trump, you know, this is going out of who wins. This is looking more after the election. They've said that they would press for stepped up government spending on infrastructure if elected president. Democrat Clinton has also proposed a bevy of other expenditure programs, including increased college aid, while Republican Trump has put forward a massive tax cut plan. You know, if you read about, you know, what options do central bankers have, a lot of it is about central bankers now playing possibly a bit of a political angle and trying to get more fiscal stimulus to help supplement what is becoming a more exhausted set of policy measures from a monetary point of view. Certainly, if the likes of Trump and Clinton, whoever gets in, start to step up and fulfill some of their promises that they've said in the run-up to the election, then certainly this may lessen the need for the central bank to provide such accommodative policy and actually increase then the propensity for them to lift rates. So not just Trump, who obviously is very keen to get Yellen out and is seen as more, let's say, policy hawkish, but it would also be the same case in terms of continuity for Clinton, but her promise as well in regards to increasing expenditure programs. So therefore putting less onus on the central bank. And that's actually a good thing for the Fed, because it means that it's less dependent on them. And if you were to go into an economic crisis, you can then rely on the government providing something as well as the central bank. So you've got dual forces at play, helping to influence the market instead of one. Just to put it in a bit of context, there were some comments out of Stanley Fischer of the Fed, the vice chair. He said increased government spending on the order of 1% of GDP would lift equilibrium interest rates by about 50 basis points, according to the Fed's computer model of the economy. A tax cut of that magnitude would boost the so-called neutral rate by 40 basis points. So that tends to put it in a bit of context as well. Taking a look then at what the current state of play is. So odds of a 2016 Fed rate rise are now at a 5-month high. You know, it seems as though as we've got ever closer to the election, it's just got more certain the fact that as Trump has diminished in the polls, the more likelihood is that the Fed will continue on track with lesser disruption to their economic outlook going forward. So this now is at 70% by most guides. So we're up at a 5-month high. And certainly it has got something to do with the fact that the divergence between what we've had with Clinton pulling away quite convincingly in national opinion polls. This is the average based on a 4-way race. 45 Clinton, 39.2 for Trump after the last few weeks where all the scandals have come out for Donald Trump. Now, one quite interesting chart is this one, Now, I spoke at a finance conference on Friday in Manchester, and this was one of the graphics that I used because I was talking predominantly about the US elections. And actually, just a few days ago, this number on the top left, this was at 257, I think it was. Now, if you remember rightly, the key magic number for the US elections in order for someone to claim the White House is 270. Now you can see that on this chart at the top. Now this is comprising things like polls, predictors, and so on and so forth to see where the balance of powers lies in terms of if it was to happen today, the vote. This is how the college electoral seats would look. And so 270 is here. You can see that denoted by that small line there. And Clinton, if you were to go off things like polls at this point in time, has already secured around 262 votes. So she's pretty much already got it without even winning a single swing state. Now, the thing that's happened here is that this number, as I said, in the last few days, keeps increasing on Clinton's side. We're now only 8 short of the magic number, and that's mainly because not really Clinton gaining much more. It's more these reds here have gotten smaller. And actually, when I took this only around 3 or 4 days ago, this graphic, that toss-up was seen at 112. It's now 150. That's because those who were leaning Republican are now starting to sit on the fence a little bit more because of this continuation of negative news flow that continues to come out for Trump. So they're now thinking, well, actually, we're a little bit more undecided. And when you start to look at the toss-up states, obviously Florida, you can see here the bigger ones. Florida's 29 votes. That clearly puts Clinton well over the line. Not to forget Ohio, North Carolina, and so on, where Clinton is already leading in those polls by a fairly significant margin. Really, it's the only one is Georgia that Trump has some advantage in. So, again, starting to look still more and more convincing for a Clinton win, but as ever, expect the unexpected. I still would say this is by nowhere near a done deal. The thing that always frightens me the most is when I look at the betting odds, because these numbers are exactly the same as the day of Brexit. And so, yeah, let's see how that pans out. We're going to be talking about that a hell of a lot more as the weeks go by. Other things to look at, obviously earnings season is still rolling on, and I had a question from someone in the live room this morning about Apple, because Apple are reporting this evening. They're going to be after market, and the question was kind of along the lines of, can I be expecting too much movement in US indices ahead of such a big company reporting? Well, I would say that the actual movement in the indices shouldn't really be too affected, because I think the question is correct, but you're looking too short term. And what I'm saying is, if I was to show you this chart, this is Apple shares in the from August to the present point. So this is a 3-month chart. Now, can anyone remember what happened here at the beginning of September? Anyone in the chat know what happened around here, around the 7th of September? So this is when the iPhone 7 was announced. And you can, if you can remember, as per most iPhone releases they've had of late, a bit underwhelming. You've got a better lens on the camera, you've got a little bit of better battery life, and that's about it. Not a hell of a lot different. Maybe the microchip and the processing power a little bit quicker. But overall, this is very typical of what happens for Apple. The only thing is, you've had a big rally in the week after the announcement. Now, do you remember those headlines that we had about Apple and actually the surprisingly strong demand that the iPhone 7 had had? Whether it was just good timing with the sake of upgrades, or the fact that people actually put a lot of value in having a much better camera and one of the best on the market. But one thing was, they were sold out, and actually demand exceeded supply and their shares shot higher. We're talking about a move from around 103 to 115 in a matter of days. Do you remember they rallied? I think it was 11%, and that equated to around $60 billion in 4 days on the back of that. And then ever since then, if I put this down to 1 month now this is what you often see with Apple going into earnings, and this is why I say that with this, it might not have too much influence on the Nasdaq today, certainly tomorrow when we get to digest the numbers. But what often happens with Apple is you buy, it's almost this buy the rumor, sell the fact type scenario. People buy into the stock price ahead of the earnings release, and pretty much, I can't remember the exact statistic, but 8 times out of 10, as soon as the results come out, people generally sell it. It's the same with the actual iPhone announcement. I think if we go back on the other chart, the stock rallies ahead of this is when Apple send out their invitation to the conference where they're going to unveil a phone. People buy it, they announce it, they sell it. It's a very standard price movement, I'd say, specifically associated to Apple. So if anything, it would be interesting to see then, can they, given the market has been quite bullish on the stock of late, I would say the bar is fairly high for these numbers coming out. So there's a propensity for them to disappoint in that respect when their numbers come after market. Key thing to look out for always with Apple earnings is revenue by product, and I thought this chart perfectly sums that up. And this is the reason why I'm so bearish Apple in the long term, is because they are pinning all their hopes in one product, whereas companies like Google, even Microsoft now with their cloud technology, are looking to diversify and take advantage of the technological leaps that are happening, whereas Apple still heavily dependent on iPhone sales. And obviously we've seen that decreasing for the first time in many years in recent quarters, given a lack of appetite now, or diminishing in China in particular, which they've been targeting. Key things to look out for with Apple. All eyes will be on the sales of the phone. One key thing though that some analysts have highlighted is that actually there's been a high amount of interest in the iPhone 7 Plus, because that actually has a dual instead of single lens camera, and apparently that floats a lot of people's boat, and that means the phone, the Plus size, obviously costs more, and that increases margins, which is good for the firm. So we'll be watching those numbers closely later on this evening. Some other headlines to be aware of for the UK. Looking at the pound this morning, it's pretty flatline. Not a great deal going on at this point in time. Now, I did have one of the guys ask me this morning about the High Court ruling. Have we heard anything yet? And the answer to that really is no. There is no set time or date. Some murmurings that it could be a few weeks, some that it could be this week. And so, again, just to recap, this is about Parliament being able to ratify agreements in regards to Brexit. Them being given that power would lessen the ability of the government to take such a hardline stance. And so if you hear a headline that they are authorised to ratifying the agreement, I'd be expecting cable to rally, and then the opposite. If power remains with Theresa May in the Tory government, we could come under some selling pressure. So at the moment, I think maybe cable is in a little bit of a sideways pattern until that news develops. And so what I'm saying then is potentially this might not be a great asset to be looking at this given point in time until that news comes out. Still, keep an ear open, it could come at any point. Now, the other interesting thing then from this morning was about inflation. And it's amazing what a jar of Marmite on the front page of The Sun can do to really rile up Middle England, because now latest survey from YouGov City shows that British public's inflation fears have shown a record jump. So this is a gauge of public expectation for inflation in a year's time recorded its sharpest jump in more than a decade this month, driven by fears of high import prices. So in terms of actual levels, the survey for US bank Citi showed in October people on average expected inflation in 12 months' time to be at 2.5%. That's a pretty phenomenal jump, up from their previous expectation of 1.7%. So in 12 months, most people in Britain expect inflation to track at 2.5%. Now, you remember rightly, the Bank of England's target is 2%. So this is where this wordplay of tolerance was issued by Mark Carney more recently, is because he knows full well that he needs to manage this perception, because if it starts to run away and go further to the upside, 3+%, he's got a real problem on his hands if yields keep rising and prices keep shooting higher, because then ultimately, more traditionally, that would be countered with higher interest rates, which is obviously not what he wants to be doing when he's committed to lower rates and QE is underway at the moment. Okay, quick look at the calendar then to wrap things up. A couple of things to look out for from this morning. I'm going to try and wrap this up quickly because you've got German IFO coming out at 9 o'clock. That is a big number from Germany. A quick look on the historicals so we can do a rundown ourselves. 109.5 was the last reading. That was the highest reading since June of 2014, I believe. And so that was an extremely strong reading for IFO. So keep an eye on that if you're trading Euro, DAX and Bund, especially with the DAX testing up at that R1 that you can see at the moment, which coincides with that high from yesterday. So again, IFO coming up shortly could trigger a break on that if it's a stellar figure. Otherwise, in the afternoon, you've got the house price index numbers and S&P Case-Shiller. These are not important. I would not worry about those. But you do have Richmond Fed manufacturing and the Conference Board's consumer confidence reading in the US. Now that came out this highest reading since 2007, pre-financial crisis, last month. So let's see. We are expecting a slight pullback from that elevated number, but still well above the recent historical norm. Okay guys, going to wrap it up there because IFO's coming out. Keep an eye on that number. It does have the ability to move the market substantially if it is strong or weak enough out of line of consensus. Again, probably I'd say an upside number would be less surprising. Any pullback down to around 106, which is where we were the prior month from that forecast busting number last month, I would say you could see the DAX pull back after this elevated move this morning. Okay guys, enjoy the session and have a good day.